Hello, everybody. My name is Zishan Hassan. I'm the tutor of Finance Reporting F7. Um, so let us start with the introduction. As I told you, my name is Zishan Hassan. I've been teaching this F7 finance reporting paper since last 13 years now, and I also have possessed a working experience in you know corporate world as an auditor and as a finance officer since a long time now. Previously, into 2022, two of the students from the Middle East countries region um, scored, world Middle East top in this paper F7 as well. Now, what are the course contents as you can see on your screen? IS 16 property, plant and equipment, in which we will study what is non-current assets, what are the ways to record the initial recognition of the assets, um, um, what are subsequent expenditures, what are the methods of depreciation, what is evaluation, and like that. Then we'll have IS 20 government grant. What is government grant? Two types of government grant are there: capital grant and revenue grant. IS 23 borrowing cost. We will do then. What are the borrowing costs? How to capitalize them? When to capitalize them? When to stop it? This will be thing we will done doing it. Then IS 40 investment properties. What are investment properties? What are the models of investment properties? Those sort of things we will do in it. Then we will have IS 41 agriculture. What is agriculture produce? What are agriculture products? The cost model, the fair value model. What are the three treatments of which is preferable? We will do in it. IS 36 impairment. What is impairment? The sudden change in value of asset. How to compute it? What are cash generating units? Those sort of things we will do in it. Then we will have IS 37 provisions, contingent liabilities, and contingent assets. What is provisions? How to recognize them? What are contingent liabilities? What are contingent assets? And what are onerous contracts? We will do in it. Then we'll have IS 38 intangible assets. Uh, what are intangible assets? How to recognize them? What are definite life assets, intangible assets? What are indefinite life intangible assets? What is research cost? What is development cost? What are the treatment of which? Then we will do IFRS 15 revenue recognition and customer contracts, how to recognize them, what are the ways to record them, the steps of recognizing revenue. Then we will move to the next standard, IFRS 16 leases. What are leases? Financial leases, what are the short-term leases, how to recognize them, sales and finance lease back. Then we will have financial instruments. What are the financial assets? What are financial liabilities? What is financial instruments? What are the models to recognize those? Fair value through P&L, fair value through OCI, all of these we will done it. Then we'll have IS 12 taxation, what is taxation, what are deferred taxation, what is temporary differences, what are permanent differences, all will be done in it. Then IS 10 events after reporting period, what is events after reporting period, what are the adjusting events, what are the non-adjusting events, and their treatments. Then we will do the cash flow statements, which we have studied previously as well. Uh, Final accounts, final financial statement accounts, consolidations, ratios, group disposals, earning per share. These are the part of the F7 syllabus. As far as exam format is concerned, we have section A, 15 marks, MCQs, 30 marks. Okay, section B, three questions, 10 marks, five requirement each, 2 marks each for each requirement. You will be get it. Then we have section B, three questions, 10 marks, five requirements, 2 marks each. Okay. So overall, 60 marks from these section A and B. In section C, we will get two questions, 20 marks each. Okay. This can be from consolidation, cash flow, final accounts, ratios, whatever it is. Now, what will be my teaching strategy? Well, we will cover whole topics. Then we will do MCQs topic by topic. And then we will cover section C, right? Now, IS 16 property plan. Man, resources controlled by an entity for more than one accounting period, and it is expected economic benefits will flow to the entity. These are non-current assets. So, resources controlled by an entity. Why, now, you might be thinking that why they use the word control and not own, because we will study leases in our upcoming lectures. And in leases, they never own an asset. They actually use it for long-term period. That's why control word is used. So more than one accounting period, that means more than 1 year, and it is expected economic benefits will flow to the entity. That means they will get something. They will earn something, right? For example, land, building, machinery. These are the examples. How to recognize the artist as non-current assets? It is probable economic benefits will flow to the entity and cost can be measured reliably. Asset debit, cash or bank credit. Initial recognition, list price, less trade discount. Uh, okay, now there are two types of discounts. Remember, trade discount and cash discount. Trade discount can be cost can be deducted from the cost of the asset. Okay, and for example, we get the asset for 50,000 and discount is 5% on it. 5% discount on it, right? And so we will deduct it from the cost of the asset. But cash discount, it is something that the suppliers have. You actually have the credit period of 30 days, but but if you pay us in 10 days, you will get the extra 2% discount. We don't sure about it, right? That either we will take it or not. So in case of cash discount, if we will avail it, we will include it in the other income. But if we don't take it, we won't include it anyways, right? So only deduct the trade discount from the cost of the asset, and then we have add installation cost, add pre-production testing, dismantling cost, and freight charges. Now, what is dismantling cost? For example, as you can see, this guy got the paper from the government, right? He was going for a mining work. Now, before the work commenced, he's got this paper in which it was written that when he was done with this work, he has to bring land into a original condition. Now, suppose the cost of dismantling is $100. Now we have to recognize it on present value on the basis of 1 divided by 1 plus r into number of years, right? So 1 divided by 100 into 1 divided plus the interest rate is for suppose 10, it will take 3 years, so present value will be 75. Now multiply 75 for every year, and when it becomes 100, pay them. That's how we have to do it. Okay. Now here is the example. An entity started construction of a building for its own use on 1st April like 7 and incurred following cost. Okay, as you can see, we have purchase price of land, stamp duty, legal fees, site preparation and clearance, material, labor, architect fees, and general overhead. So they're saying materials were greater than anticipated on investigation. It was found that materials costing 10 million had been spotted and therefore wasted, and further 15 million was incurred on materials as a result of faulty design work. As a parallel of these problems, work on the building ceased for a fortnight on October X7. It is estimated that approximately 9 million of the labor costs relate to this period. The building was completed on 1st July X8 and occupation on 1st September X8. Required. You are required to calculate cost of building that will be included in non-current asset. So purchase price of land 250,000, stamp duty 5,000, legal fees 10,000. Site preparation and clearance, 18,000. Okay. Um, Material cost is total 100,000, but minus 15 and 10 as we just read it. So 25, overall 75,000 will be capitalized. Material, we will deduct 9 million from it, total 141,000. I'm taking millions into thousand by the way. Architect fee, fully. General overhead will not be capitalized as they have to incur anyway. Either project is incurred or not. So total cost will be capitalized will be 519,000. Now subsequent expenditure, as you can see, uh, subsequent expenditure on X1, we bought an asset for 100,000. Life is 5 years. On X2, its first depreciation is 20,000. NBV is net book value is 80,000. On X3, again 20,000 expenses incurred, 60,000 is the net book value, 20,000 is the expenditure we have incurred. And due to that expenditure, either increase in useful life happen from its life will increase from 3 to 7 years. Increase in efficiency. They are producing earlier they were producing 5,000 units. Now it's due to this expenditure, the machine is producing 7,000 units. Decreasing operating costs. Uh, Firstly, suppose this machine was giving the bill of 10,000, now it's giving the bill of 7,000. So either of these things happen due to that expenditure. That's a subsequent expenditure, and we will capitalize such cost. Right. Now depreciation. Depreciation is a systematic allocation of the depreciation asset of an assets over its useful lives. Now, or you can say it is a non-cash expense, and we are allocating this expense to the cost of asset because we believe that if assets helping us to earn, it has some cost as well, and depreciation is that cost. When we have to start allocating the depreciation expense, as soon as it's available for use, we have three methods for it. One is straight line method, other is reducing balance method, and third is machine cost. So straight line method, for example, asset has cost 100,000, life is 4 years, scrap value is 20,000, the requirement is depreciation. So 100,000 minus scrap value is 20,000, life is 4 years, the depreciation amount is 20,000. Depreciation amount is 20,000 per annum, by the way. And see, it's giving us evidence that straight line method assumes that every year it has a equal usage. Now we have another one, reducing balance method. It assumes that in earlier years, assets earn more, so deduct the more expense of depreciation, and later years it's getting lesser and lesser. For example, asset life is 100,000, depreciation is a reducing balance method, 20%. Depreciation required is the requirement, right? So asset cost 100,000, depreciation 20%, 20,000. We get the NBV of net book value of 80,000. Depreciation expense 20%, 16,000. NBV 64,000. Depreciation 20%, 12,800. Net book value 51,200. Depreciation 20%, 10,240. Net book value 40,960. See, in earlier years, it's deducting more, then it becoming lesser and lesser in later life of the app. Now, revaluation. What is revaluation? Without incurring any expense or any usage, asset value is going up or down. That's revaluation. Now, first time upward revaluation. We bought asset for 1,000. Now, later on, it becomes its value is 1,500. So, when we got asset for 1,000, asset debit, cash credit 1,000. When assets goes up, values goes up, asset value debit 500. But now, is it sold? No. So we will bring it the extra amount to the equity part, and there is a reserve known as revaluation reserve. And when equity goes up, it gets credit. So asset debit 500, revaluation reserve credit 500. First time downward valuation. Asset values goes up by we bought asset for 1000 and its values goes down to 750 later on. So when we bought the asset, asset debit 1000, cash credit 1000. Uh, Asset credit 250, PNL debit 250. Simple. Then we have first upward and downward valuation. Asset values from 1000 to 1500 and then 750. When we bought the asset for 1000, so asset debit 1000, cash credit 1000. Uh, Asset values goes to 1500. It's just like the case one. Asset debit 500, revaluation reserve credit 500. Now the third one. Asset values goes down by 750. How much the revaluation reserve we booked till now? 500. So we will reverse it. Revaluation reserve debit 500. How much left? 250. That will be expense to PNL, profit and loss account, debit 250. Then last case, first downward, then upward. We got the asset for 1000. Simple asset debit, cash credit 1000 or bank credit. Okay. PNL debit 250, asset credit 250. Okay. Then we have asset, we got the asset for value goes up to 1500, so asset will be debit by 750. How much expense we have booked yet? 750. We will reverse it, so 750 PNL credit. How much left? 500. That will be go to revaluation reserve. Revaluation reserve credit 500. Depreciation of revalued asset. Depreciation must to charge based on valuation less residual value, that means scrap value, over the remaining useful life. The whole charge will go to profit and loss account. So what we will do: depreciation expense debit, accumulated depreciation credit, revaluation reserve debit, and retain earning credit. So here is the example. On 1st April 2008, the fair value of the XU property was 100,000 with a remaining life of 20 years. Zoo property is revalued to its property and its year end at 31st March X9. The property was valued at 86,000. The balance on revaluation surplus at 1st April X8 was 20,000, which relate to the property. Zoo does not make transfer to realize profit in excess of depreciation requirement. 100,000 divided by 20 years is equal to 5,000 is the depreciation or evaluation. Carrying value of asset: 100,000 minus 5,000, 95,000. Leasehold valuation 31st March X9, 86,000. Loss 9,000. So if the opening did not exist, opening reserve did not exist, revaluation of 9,000 would need to be taken from statement of profit loss as an impairment expense. Now finally, disposal of revalued asset. It should be accounted for in statement of profit or loss in the period it occurs. Any balance in evaluation reserve relating to asset should not be taken to retain earning. Okay. ABC example. ABC purchased a property costing 750,000 on 1st January X4 with useful life of 4 years. It has no scrap value at 31st December X4. The property was valued at 810,000, resulting in gain on revaluing being recorded in other comprehensive income of 135,000. There was no change to its useful life of 135,000. ABC does not make transfer to realized profit in respect of excess depreciation on evaluated assets. On 31st December excess, the property was sold for 900,000. Now, how should the disposal on the previously revalued asset be treated in financial statement for the year ended 31st December X6? How we will do it: sale proceeds 900, valuation at 31st December 810, less depreciation of 2 years. So 810 divided 9 into 2 years, 180. Overall value is 630. Profit on disposal is 270. So revaluation surplus of 135 will be debit and retain earning will be credit. I hope you get it. Now, if if you want to enroll for the session, just open the website as you can see on your screen, accountancy.com. Go below, slide here, find out if you want to buy it English, right? So financial reporting in English. Click on it. It's open. The cost you can see on your screen right now. I'm sitting from Pakistan, so I can see price in PKR. But if you are out of Pakistan, the price will be in dollars. And currently, it's 35% off for next few days. So it's a limited time offer. Get it now as soon as possible. Uh, Notes will be included. All topics are there. Recorded lectures are already there, right? And the preview lessons are actually demo. And if you want to buy, click on the buy now. You have to register on the website, enter the details, sign up, then use to pay via Visa or MasterCard. Use Pay Pro options, enter your details, which are safe and secure. If you have any questions, you can ask me on my WhatsApp as well. Here is the WhatsApp link on the website. Also, the number as you can see 923341777706. So I hope you got it, and we'll see you soon.